We heard Christine Lagarde giving a lot more detail about how she wants this to be interpreted. Nigel, what are your assumptions about how loose policy remains at the ECB, given what we now know about this strategy?
I think it's a really clear message that you're getting, not only from the ECB, actually, but also from the Fed and indeed the Bank of England. And it's that, policy is going to remain very accommodative. And I think that's why you're still seeing equity markets continuing to reach new highs. We've had a period of volatility. I expect that might continue over the thin summer months. But actually, the underlying environment here is going to remain very supportive. Interest rates are going to remain low for longer. And you really want to be more into real assets and into equities than you do want to be into the bond markets at this stage.
Nigel, part of the European equity outperformance story in the first kind of part of this year was obviously the great China recovery story. How much of a headwind is it for European stocks if they're, given the slightly changed geopolitical landscape and China regulatory landscape towards European stocks? How much of a headwind is that going to be?
I think it's really interesting. I mean, the Q2 numbers, we're just nicely getting into the Q2 reporting season for European stocks. And, we're seeing consistently beats coming through. And the narrative that we're hearing from management is that this is, really strong conditions coming through from, both the Europe and from the US as well. Asia isn't as strong, and that's certainly true. But I think for European stocks, that can be made up in other parts of the world. And I think the recovery that we're seeing coming through across the globe, actually, a lot of those European stocks are beating expectations. I expect that to continue. And I'm actually expecting to see further upgrades coming through as well. So I think it's less of a worry than you might think. I think it's been taken up by other areas across the world.
So you sound pretty positive about stocks. You say that's the place to be. What is the risk? What's the biggest risk, Nigel, to your strong stocks view?
Yeah, the risk, well, there are two risks probably. One is that interest rates go up much quicker than we anticipate. Or the second one is that the earnings story actually fades away and that the recovery that we're seeing is not sustained in 2022. Markets now are already pricing in the recovery for 2020-21. We need to look at what the environment is going to be in 12 months, in 18 months' time. And our view is that actually it's going to be still a positive environment. Yes, growth will be a little bit slower than we're seeing year on year now, just as we sort of lap the downturn that we had last year. But we see the conditions in place for a sustained, long-term recovery in the global economic growth story. And that provides a very positive background for equities generally. I do think that equities will derate over the next 12 months, but that will be more than made up by the earnings growth story that we're seeing developing across the world. And that's really the underlying growth that will drive the markets higher over this next 12-month period.